Do you want to know how a CEO of an investment research company is choosing their stocks? Watch this video. In this video, we are with Andrew Stotz. He's the CEO of Stotz Investment Research. He is also the host of the podcast, My Worst Investment Ever, ever with emphasis, and also the co-founder of Coffee Works in Bangkok. So here with me, Andrew. Hello, and good afternoon to you there.
Great to see you, Neil. I have a lot of friends in the Philippines, so hopefully I can provide some knowledge or some ideas.
So my first question, can you explain your investment philosophy and approach to investing and also in selecting good companies at a very attractive prices? Of course, the attractive prices is relative. So can you
Yep.
share more of that?
So I'll go back to when I moved to Thailand. It was 1992. I was teaching finance, and then I got a job as an analyst. And in my first year or two as an analyst in the Thai stock market, I really didn't know much, and I didn't have much money because I was a young guy. So I didn't do much investing initially, and I just tried to study everything I could until I started to invest. And I was an analyst picking stocks for my clients around the world. Over time, I also became a head of research, running a team of analysts, analyzing stocks and trying to figure out what stocks people should buy in the Thai stock market in particular. Now I look at markets around the world. But I think the key thing is that I was definitely interested in value investing, and I spent a lot of time analyzing the fundamentals. But I got to a point where I read this book by Joel Greenblatt called The Little Book That Beats the Market. And he had a methodology that he taught, which was basically to buy high quality, high return companies at low price. And he had a way of ranking them that made a lot of sense to me. And so over time, I basically built a whole system that I call FVMR, fundamentals, valuation, momentum, and risk. So the way that I look at stocks is I look at all four of those factors. I'm no longer a value investor like I used to be, because I found out that, value is not everything. If, for instance, if money comes flowing into the Philippines market, as an example, stocks could go much, much higher. And the result of that is that I saw the value of momentum. So I can say that I use these four factors: fundamentals, valuation, momentum, and risk now when it comes time to picking stocks. So maybe that's kind of the origin of what I do. And I can explain more about it, but maybe that's a starting point.
Yeah, thank you. Thank you for sharing that story. That what you have done is from value investing, then your approach now is FVMR. I'm trying to also memorize it, like fundamentals, value investing, momentum, and risk. So what's the story behind it? And the second, with the FVMR, are they weighted the same, or there's a letter there where you value most, like maybe the fundamentals most, and then the risk maybe just 10% of it? Like, how's the approach with that?
So the origin of this was that I was doing typical research where I was, as an analyst, I was visiting the companies as an analyst. I was building out the model. I was coming up with my ideas, and I created my portfolios. But the truth is, they didn't do as well as I thought. And I spent so much time doing research that I started to question. And I remember at one point selling out everything I had and said to myself and my teammate or my business partner at the time, we need to figure this out. I want to look at it differently. And at that time, all that we did is we went back and asked the question, what worked in the past at picking stocks in this market, in each market? And once we found that, let's say there's one or two factors. And when we talk about a factor, it could be under fundamentals. One factor could be return on equity. It could be net profit margin. Under valuation, it could be price to book. It could be EV to EBITDA. It could be implied growth, whatever. And under momentum, it could be earnings momentum, it could be price momentum. And under risk, it could be financial risk of the balance sheet or the risk of the volatility, let's say, of the stock. And so we tested probably 50 to 100 factors till we found the factors that worked. And we looked for a mix of factors, let's say 7 to 9, 7 to 10 factors, because we didn't want to just pick that one factor that worked. Let's say price to book worked better than anything else over the last 5 years. Well, that's good information. But if I only rely on that one factor, what if that factor goes out of style? And therefore, we look at a mix of factors. And that's how we got started. Now, the truth is there's hundreds of factors that we can test and go through, and we build our strategy using a small number of factors. But it could be that 2 factors work under valuation and only 1 work under fundamentals, and 3 work under, momentum, as an example. And so the factors will kind of naturally, let's say, naturally divide themselves based upon what we've seen in the past. And so ultimately, we weight each factor equally. We have done some things where we added weight on particular factors, but we found that that didn't produce the performance that we wanted. So that gives a picture of how we do it.
Right, right. So ideally, it's like all the same, but in some instances, like the weight would be different. With your approach, the what do you call it again? FVMR? Did I get the
Correct.
right letter?
Yep, you
Or
got it.
FMRV?
No,
Or
FV, fundamentals, valuation, momentum, and risk.
momentum and risk?
FVMR.
Yeah. And you said like you are trying it in different industries, different regions. So the FVMR, it's even not just in Asia, but even in North America.
Everywhere, everywhere. Because what we're doing is saying, okay, this is our framework. Then we're going to test that market to try to understand what worked and what didn't work. And then part of the thing that we're going to do once we've got our 7 to 10 factors, we're going to assume, Neil, that those factors are going to outperform in the future. And that is an assumption that we're making. And so some people would say, why don't you look? So a lot of times we used to look at forward data, but really we found that using historic data is just good enough. And so with historic data and information, we're able to basically identify what worked in the past, and then we're going to come up with an assumption that that's going to work again in the future. It may not, but when you have 7 to 10 factors, then you're going to basically see that, most of them will probably still work for a while. And then you have to reevaluate your methodology. So this is just what I would explain about this, Neil, is that this is a methodology. And it's my methodology based upon the way I think and the way I feel and the way I want to do it. I would highly recommend for the listeners and the viewers, do not do my methodology. Do your methodology. But you can learn from my methodology. So let's say you're a value investor. You may end up owning a stock like I owned many years ago, a company that was a shipping company, and it was so cheap. I mean, it was trading on 0.5 times price to book, very great management, very good business. And I held that stock for a long time, and it never moved. I was caught in a value trap. And now I see the importance of understanding momentum. Now, for a value investor, they say, I don't care, Andrew, if it doesn't go up for 3 years. If I bought a value stock, I'm going to hold it until it comes true. That's your style. That's great. It's not my style. I now realize that I want to, if I'm picking a cheap stock, I want to make sure it has some momentum before I get in.
Right, right. Because again, like what you said, some people, they come in, they got it cheap, and then wait for it to happen. For
Yeah.
you, at least with the FVMR, you wait for the momentum. That's why it's crucial also that that company has momentum. With that said, like at least with your approach, like what is the timeline for you in seeing it into fruition? Because of course you see the potential of the stock
Yep.
with your methodology, and you said like you are not waiting so long, like after 5 3 years for it to get to the
Yep.
price. Like what's your normal timeline for it.
Okay. So basically, as an analyst, the thing that we do all the time is we look at the earnings that are coming out of the companies, and they come out every 3 months. We can look at the price every day, but price is not, that's not fundamentals. Price is valuable because basically there's someone out there that's probably figured something out about a particular company, and they've done work on it that you haven't done. And when the price starts moving, it sometimes means that somebody else has identified something, and so you may want to try to ride that momentum. But from my perspective, I look at quarterly results as new information. So I reevaluate my whole portfolio every 3 months, and I may change 50% of the stocks in that portfolio. I may change 20%. I may change 80%. It just depends on what's going on. And ultimately, a key thing that we want is I want to be able to choose from the largest number of stocks as possible. And that means that if I can be choosing from stocks in ASEAN, if I can choose from stocks in Asia, if I can choose from stocks globally, the more I get to choose from, the better opportunity I have to find something interesting.
Yeah, that's good. At least as you increase the range of the companies you're checking, more options basically, more options. But is there a certain filter? Like, is it the first stringers, second stringers, or maybe in some nations you are checking this, or like you just check whatever's available on the platform?
So, the good news about, let's say, for someone that's watching this, that's a individual investor, is that generally an individual investor is not going to have that much money. So they can go into smaller cap stocks, mid-sized companies. Generally, what I'm looking for is a company that has a market capitalization above 250 million US dollars and $1 million a day of average daily turnover. I can go below those things, maybe down to 250,000 US dollars, but I can't go down really. I would prefer to be above 250 million in market cap and $1 million a day. So that basically eliminates a lot of small and mid cap companies that other people may get in. But my purpose is not only to find attractive stocks, but it's also to find stocks that I can get in and out of.
Right. Yeah. At least you know that anytime you can go in and out, not just like the shiny stock. Speaking of stocks, I know that you also have a podcast, and that's what we said when
Mm,
we introduced you, that
mm.
you are the host of the My Worst Investment Ever, with emphasis ever. Can you share the story behind it? Is that before the FVMR methodology or after the FVMR methodology?
So FVMR methodology has been going on for almost 15 years that I've been developing it. And so the podcast came along about 4 years ago. And the idea of the podcast simply was to interview people about their worst investment ever and try to learn from that. And so I've interviewed all kinds of people, including your brother, in fact, on this show, Marvin, and he came on and he told his story, and that was a good one. He was episode 467. That was back in 2021. And so basically what I've learned is the number one mistake that people make is they don't do research. They find an idea, they read something, they hear from someone, and they just put their money in it rather than spending the time doing the research. And I'm a research analyst in my heart. In fact, I have a course called Valuation Master Class Bootcamp where I teach everything I know about being an analyst. And the point is that I really love to help people do deeper research. And I believe that with deeper research, you are going to reduce some risks. You're not going to reduce every risk, but you're going to definitely reduce some risks.
Right, right. Because it's really about managing the risk of what you can tolerate as opposed to the ratio of its reward, because you need to tolerate it. And what's important is you can sleep peacefully at night knowing the money that you are putting in that investment. So like what you've said in the podcast, that you have the worst investment ever. You are asking people about their worst investment and getting the gems, getting the learning so that your audience will learn from it, because that's important. You learn from others' mistakes. But
Yep.
can we also learn again from your worst investment ever, so that at least people who are watching, they really don't know what to do, they can at least avoid the mistake that you had maybe years or decades ago?
Well, my worst investment ever was investing in a startup company, and I was an angel investor in a startup, and it started off pretty well, but eventually what happened was I felt like we had to go to the next level to market this product worldwide. And in order to do that, you probably need $3 to $5 million for a marketing budget and a sales budget, and really to push out there into the global market. And I came to the conclusion that the guys running it just weren't going to be able to get it to that level. And I realized if we can't scale to that level, I got to get out. And when I got out, that meant I lost everything on that investment, and that business eventually had to shut down. And it was a big loss. And it didn't happen when I was young. I mean, it happened, I don't know, 10 years ago or so. It was, I was supposed to be smart enough to not make that mistake. But, I got excited about this idea, and, and I continued to invest in it thinking that it was going to go somewhere. But eventually I woke up. So I always tell people, if you're going to be an angel investor and invest in startups, the only advice that I would give you is make sure that you invest in 10, never invest in one.
Right, because it's like the more entries, the more chances of winning.
Well,
Because
in
if
the
you put,
startup world, 9 of those are going to die.
right,
So
right, right.
hopefully you have one that does well. Now, some people
Yes.
will say, they say to me, well, Andrew, I mean, I don't have that much money and I can't invest in 10. Then don't invest in startup, because the
Yes.
probability of you, it's like going into a casino and you got a, $10,000 that you're going to take to the weekend for the casino, and you go up to bet, and the first bet that you take, it's like on Russian roulette, and you put down the $10,000.
All
That's
in.
it,
You did all
all in.
in.
And and then you lose, and then the rest of the weekend, the rest of your family and friends are out having fun, and you're sitting there going, oh, I just lost all my money.
Right, right, right. At least, like, based on statistics, 9 out of 10 in angel investments fail. But that one investment, you just only have to get one company, and it would even offset all the losses of the nine, right?
Maybe.
Maybe,
It's
maybe,
a, it's
hopefully.
it's a question of, what is successful. So, for instance, if we think about Philippines, I've been to the Philippines many times, and I've been to some nice restaurants and some street carts and stuff like that. There's people that set up restaurant, and they say to themselves that they're successful in the sense that they've survived, the startup period. But are they really successful where they're able to extract money out of that business through dividends or other things like that? Generally, it's not the case. So even the ones that survive aren't necessarily profitable or valuable for the outside investor. They're paying a salary and all that, but that's what I would say. So ultimately, to me, in a startup world, I say get dividends. And if you can
Right.
get a business from startup to, let's say, 5 years from now, 7 years from now, that it's paying dividends, then you really have gotten, a good business.
Yeah, because of the passive investment that you're getting, because of the dividends.
Yeah,
You
it's
mentioned,
one of the things I want to
yes,
mention that you mentioned about passive investing, and I know it's a pretty hot topic, but I wanted to give you my opinion on it and say
yeah.
there is no such thing as passive investing. And it's because of a technical calculation that we need to understand. When we look at investing and we look at the investing over the long term, I'm sure Neil, as well as others listening, have seen the chart that shows that your wealth just grows exponentially in later years. So if that's the case, you're going to be super rich like Warren Buffett, because if you can let your money compound over many, many years, it will grow like a hockey stick to be massive. However, the problem is you cannot remove any money from that investment. the assumption is in that chart of a hockey stick is that you reinvest every single penny or peso or baht that you earn from that company back in that company, and that it's earning at a same level of return. And this is why I say there's no such thing as passive, because if you are making good money on your portfolio and you start extracting the dividends that are being paid rather than reinvesting them, you are now converting a exponential curve to a linear curve, and you are no longer getting the benefits of compounding. And therefore, I would say the only time that you can say that there really is passive investing is when you've gotten your portfolio up to, let's say, $5 million, $10 million, whatever that number is, that you can spend the money out of that portfolio. You don't have to worry about having to reinvest in it because you've got enough. Does that make sense? Or you have any question on that?
Yeah, it makes sense in a way where you have to go all in with all the earnings so that the compounding effect would really make sense, and you need a certain money like 5 million, like you've said,
Hmm.
to really reap the benefits of the earning, right? Am I
Yep.
getting it right?
Yeah. So the point is that when you start off investing, and let's just imagine you're putting your money in a bank for 10%, and you get, a fantastic rate of 10% every year. So in the first year you put in 100, you earn 10%. That means you earn 10. Now you have 110 in your portfolio or in your bank account. If you earn 10% again in the next year, you're going to earn it on the initial 100 plus the 10 in interest that you earn. And the interest on the interest, you're going to earn 1% on that 10. And so it's the interest on interest component that is what makes the hockey stick chart or the exponential rise. And that interest on interest component basically can become, after 30, 40, 50 years, like Warren Buffett, it can become as much as 80% of the total value of your portfolio. And so the result of that is that you never want to, and that was Charlie Munger's thing, is never interrupt the compounding process. And by taking money out of your portfolio, whether that's by taking out dividend or taking out some money out of your portfolio, you are interrupting the compounding. Never interrupt the compounding process. And that's why I advise, when I wrote a book called How to Start Building Your Wealth Investing in the Stock Market. And I wrote it for my nieces. I wrote it for women, basically 5 women, my 5 nieces. And at 18, I got them investing. And I basically told them, buy an index fund that owns every stock in the world, and never, ever, ever sell. You want to become rich 20, 30 years from now? You can do it just like that.
Yeah, that's a good advice, because when we say index funds, basically those are the companies that's profitable, and if it's not profitable or whatever metric of that index, they will just remove it and put another company. So basically, that it's just going to be profitable. So
Yep.
that's a good tip.
Yep.
So how old are they now? Like how many years have they been practicing that advice, like the index?
They've been, let's say my nieces are now between 28 and 34 now. So they've been investing since they were 18. I gave them each $3,000 when they graduated from high school. But I didn't let them have the cash in their hand. I said, we're going to open up an account at Vanguard in those days in America. And so we opened up the account. So they've been investing over those years. But Neil, I would say I still, even though I wrote a book about it, and I gave my nieces, Uncle Andrew brought money and helped them set up an account, I still failed, Neil. And the reason why I failed was because I didn't get them to really see the importance of contributing every single month.
Right.
So they saw this big $3,000 lump sum, and they thought, I'm going to get rich from just letting Uncle Andrew says, leave this money in the market. Well, yeah, that 3,000 is going to grow to be something very big, but you need to contribute on a regular basis. And so that's the one thing and then eventually my nieces got shiny object syndrome. And then they started, oh, I want to buy tech. I want to buy this. I want to buy that. And next thing you know, they got themselves caught up in a bunch of stuff. And then that makes it more difficult. So I think you really have to have discipline. I'm a very disciplined guy when it comes to life and when it comes to my investment structure, my investment style, for sure.
Right, right. You are a good uncle to your nieces. Uncle Andrew. Can you be my uncle?
Exactly. That's what a lot of people say when they get my book or they listen to me speak. They say, "Can you be my uncle?" I said, "I'm out of $3,000 bills."
Yeah, but that is a good story, not just to your nieces, but also to the people who have read your books.
Mm.
You mentioned that you are a very disciplined guy. I'm sure writing a book is also birthed out of your discipline in distilling, organizing information. But I'm also empathizing or coming from what if the person who is watching now, watching us, learning from us, and he feels like or she feels like she or he is not as disciplined in setting aside money, in investing, just like your nieces, the 3,000 is there, but there's no monthly increments. What's your tip to people who think they are not disciplined, at least yet?
Yeah, I mean, that's part of what I had to deal with when I wrote the book was how do I make sure that for people that aren't interested necessarily in investing or they're not disciplined. I'm going to assume that anybody watching this is interested in invested, but let's just say that they are not that disciplined. I would argue that the best way to do it is to write down your principles of what you believe in and set up a structure, of a monthly contribution, maybe have a celebration day at the end of every month that you've made your contribution. The other thing is you have to simplify things. If you really want to get some discipline and you want to build wealth over time, you have to simplify things. In my niece's case, my advice to them was find the one mutual fund or ETF. In their case, it was a mutual fund that owned every stock in the world. And I helped them to find that one. At the time, it was the Vanguard VT fund. And that one owns almost 10,000 stocks across the world. The benefit of owning a fund or an ETF that owns every stock in the world is that you don't have to worry anymore. Should I put my money in Germany or US or Philippines? It's already doing that for you. The second thing why this is such a great place to start, and particularly for someone that doesn't have discipline, is it also has diversified across sectors. So you may say, well, I don't want to be too heavy weighted in tech stocks. Well, you're going to own every other sector when you own every stock in the world, basically every large and liquid stock. And so it really gives you total global market exposure. And it's as much, let's say, the lowest that you can go on the risk scale and still get equity returns. And so that's why I think it's an attractive thing for people that maybe aren't disciplined or they've made mistakes and they're looking for a way to get started. Now, of course, picking stocks, building portfolios is great, but you may want to start by saying, how do I build up $100,000 in a passive fund right from the beginning, as a way of testing myself. So those are some ideas.
Right, right, right. At least those are ideas that at least people and we can learn from it. I just want to just go back, like when we use the word successful, and successful is relative to the person. It can be successful to the person doing the business, but in the outside perspective of other investors or business people, it's not successful. So, in your terms, like at least your definition, what is a successful business, successful investment for you?
So first of all, I don't really care what other people say. I mean, obviously we all care to some extent, but there's so many stupid people and stupid things that stupid people are saying, and people that don't do research, they're not thinking about things, they're just repeating. A good example, I was in Hong Kong and I was giving a speech for a large group of students that were graduating from university. And then I said, I'll be available for questions after the Q&A session. So I went to the back of the room and I had a lot of students around me asking questions. And one lady came up to me, a young girl that was graduating from university. She said, I really like finance, but I studied accounting and I heard it's really hard, to go from, accounting to finance. And I said, who told you that? And she said, oh, I don't know, but I just heard it. I said, so you're going to base your life on something that you heard from not even anybody? You can't even tell me who told you it? Nonsense. What you got to do is go out and find your way and figure out your way. It's nothing wrong with talking to other people and following other people for some things, but ultimately the world is, we can do what we want to do. And so that's, to me, success is finding my own way, doing my own thing. I like, independence, and I like to be able to do my own work in my own style, in my own way. And for me, I wake up very early. I start work, at 4 in the morning or so. And, that's my style. It doesn't necessarily work in a corporate environment possible, but, you know, that I would say to me, that's success. The other thing is like, what is success? Well, one of the reasons why I moved to Thailand 32 years ago is that I got the same vibe that I got in Philippines, and that is, and other countries around Southeast Asia, and that is, being happy, having friends, having a good family relationship. Like these things are where true success comes. When my father passed away 8 years ago, I brought my mother to live with me here in Thailand, and I can say that it's been 8 years that we've been together and here in Thailand, and it's taken my relationship with my mother to a whole nother level. And thank God I was able to do it. And so, what is success? The ability to take care of our parents, being, sincere, being trustworthy. I have business partners in both of my businesses that I've worked with, for one for 25 years and the other for 35 years, and we've never broken trust. So trust, being a when I asked my dad this question, Neil, towards the end of his life, I asked him, "What is it you're most proud of?" And he said, "I build a trusting family." Like, get real about what is, important in this life. Money is important, investing is important. I value learning, and I've read between 3,000 and 5,000 books. In fact, I I nowadays, I basically, have read pretty much almost every major investment book out there, and I've read every major highly ranked business book out there, and tried to apply these things into my life. So yeah, read, learn, build trust, have a good relationship with your family, be careful with your money, reduce your risk, those types of things. Keep on learning.
Yeah, it's amazing that you are a voracious learner where you have not just read hundreds but even thousands of investment books. So the wealth of knowledge that you have, it's just really amazing on how you connect the dots of what you've learned from different books. Maybe I just have a question, because some people who are watching us, aside from learning from videos from YouTube, they are also wanting to learn in books. Of course, aside from your book that they can order and buy and they will learn, from the books that you've read, the thousands of it, do you have like a top three, top five recommendation on where they can start? Or
So basically, the way that I do this is that uh, what I've done in my life is I have looked at every major business and investment book that's out there. I went on Amazon and I scraped the data off of Amazon and Goodreads, and I created a scoring system because I'm an analyst. And I basically identify what are the top books of all time in investing and in the area of investing and the like. In addition to that, I also then basically have read every one of those top books in not only investing, but also in management and other things like that. And then I created cheat sheets and all of that type of stuff for these books. And then eventually what I did is I created courses. So I actually have a whole series of courses on different topics that are based around the book. But let me give you the list of the books, some of the books, the top books that I've measured and looked at and thought these are the best books. Of course, the top one is The Intelligent Investor by Benjamin Graham. But most people can't read it. It's just old and a lot of things don't apply. And so that's why I have a course on it where I simplify it and provide a whole way of understanding it. The second book that I would recommend is A Random Walk Down Wall Street. It covers almost all the topics, including factor investing and all kinds of things. I've also created a course for that. And then the third one, out of 9 books that I highlight, the third one is A One Up on Wall Street by Peter Lynch. So Intelligent Investor, A Random Walk Down Wall Street, and One Up on Wall Street are, to me, when it comes to picking stocks and building portfolios, those are the best. There's also a whole nother group of books that I look at, I call Building Wealth. And those are like The Psychology of Money, The Simple Path to Wealth, The Millionaire Next Door. Those types of books are more generally about building wealth, not about picking stocks. But about picking stocks, it's Intelligent Investor, A Random Walk, and One Up on Wall Street.
All right, guys. So if you are watching, take note of that from the guy who read thousands of books. So take note of that, Intelligent Investor. And if you do not like reading books, good thing Andrew made a course of it. So we can put some links there. And I'm sure people would learn a lot from it in terms of investment. Speaking of investment, again, like because you have a methodology like FVMR, but in terms of seeing a stock, do you see a stock as, oh, this is an undervalued stock? Do you still have that, or always just the FVMR?
So it's like, think of it this way, Neil. Imagine that you're looking for a young man is looking for a girlfriend, or a young woman is looking for a boyfriend. If the only thing that you look at is the looks of the person, you're going to miss some of the most important things, like, are they trustworthy? Are they a good person? Are they happy? Are they fun to be with? All of those types of things you're going to miss. So ultimately, I always look at, all the different factors. So, and I look at the company from many different angles. And then once I've isolated it down to a small number of companies, then I go into more detail. One of the companies that I had in my portfolio, I've recently exited it, but it was Malaysia Airports, and that was one where I saw a lot of revenue and other profitability momentum, and that momentum wasn't coming through in the share price. And what I was seeing was a turnaround that was happening. And that turnaround was starting to drive the profits and the revenue and the earnings, and the market hadn't yet, priced it in. And so that was a recent one that was up like 50% in the 3 months that I held it. I ended up exiting it when I felt like it was at, I had gotten enough out of it. So I'm definitely not the type of investor like build a portfolio of 10 stocks and own them for 5 or 10 or 20 years. That's a different type of guy, man or woman, and there are many people successful with that. But my style is a little bit more active than that.
And I think it really suits your personality because you are a very disciplined guy,
Yep.
where if you put the plan to it, you will execute it regardless of how you feel or how the market is going. But according to your plan, you will execute it. And I think it also boils down to the factors you're looking at, the metrics. I'm sure the FVMR helped and is helping. But are there any other factors you mentioned, like you use a parallel, like looking for a spouse? Like it's not just the looks, but the more characteristic traits, the more factors, the better. So aside from the FVMR, like you mentioned, like you have like seven, like at least seven. So aside from the FVMR, what metrics, factors are you looking at?
So let's say that the metrics or the factors are underneath the categories of FVMR. And so one of the factors that I look at is revenue growth. If the company is generating or accelerating its revenue growth, I like that. And if it's not causing profits to go up that much, sometimes that's even more interesting, because it means that there's some underlying growth, but it hasn't yet come through to the profits. And so maybe the market hasn't looked at it. So revenue growth is one that I like a lot. Another one is asset turnover. How much revenue is this company generating relative to the assets that they have in place, and how does that compare over time and against peers? Those types of questions, those types of measures are what I would call kind of above the line, bigger measures than, everybody's probably looking at net margin or ROE as an example. And so the more we can look at different things, you could look at, and I've tested things like the change in the number of shares outstanding and things like that. So I look at a lot of different factors, but ultimately all of the factors fit under either fundamentals, valuation, momentum, or risk.
Right, right, right. At least you know what categories they will fit
Yep.
in terms of that. And you mentioned one of the things that you're looking at is the revenue growth for the company. Like, at least to some people who is not familiar with that metric, what is a good number of a revenue growth? Is it 5%, 10%, 50%, 100%?
Well, it's a good question to ask, for people that are watching this, what do you think? What would you consider to be good revenue growth, maybe average revenue growth? Well, I've tested this over 26,000 companies over 20 years, and I've calculated what was the average revenue growth. In addition, what I calculated was I looked at the stocks that really significantly outperformed, and I tried to understand what was their average revenue growth. And what I found, Neil, was that the average revenue growth was much lower than I thought. This is the publicly listed companies. It was 6%. The average company is growing at about 6% in revenue. And what I found is that if a company can sustain growth at 10 or above, then they'll probably be a very good investment over the long term. So one of the lessons from that research that I did, along with so many other research that I've done over the years, is that you don't have to have a company that's just incredible revenue growth, above average at about 10% or above every year, and sustaining that is very likely to drive performance.
Right. Thank you for giving an insight to it and context, where a conservative 6% is just like the typical company's revenue growth. But at least if you want to make more bang for your buck, at least choose higher revenue growths, like
Yeah.
10%.